Welcome to another weekly Market Insight, where we try to sift through the noise to get the signal to give you actionable advice so you can make informed decisions. Today, joining me is Chris. It's St. Patrick's Day. The market's celebrating this morning with a green day, and we had a nice green day yesterday. So happy St. Patrick's Day to all that are watching their portfolios in the overall market.
Really short-term trends look good.
Yeah, really short they are. This morning looks great so far. We all know that headlines can change that in an instant, though. We continue to see inflation as our high risk. I think we're going to talk about that, but I want to talk about just where we are in the market and really things that we're just discussing in the investment committee. And what are the ones that are performing better? Well, commodities is one thing that's really doing well. We've talked about the need to be cautious adding those two portfolios and how much they've appreciated. And when you have run-ups like we did in energy, we had mentioned last week of just how unstable those type of price movements are and why we didn't want to add. And then U.S. domestic, especially on the value side, are doing better than the money market fund. But pretty much everything else is not.
S&P and a lot of other indices are cap weighted. So they're weighting the holding position by the size of the company.
Yes.
So energy, which makes up a very small part of the index, isn't going to be able to hold up the index on its own. It's just too small.
So with this many names underperforming, one of the things that we want to look at, and we look at on all the time, is our wide moat stock portfolio. Is we like to look at the micro, meaning what's the underlying company? What's the cash flow? What looks good for that specific company? The macro or that sector. So if you're in 2018, you may have a company that looks great within the energy sector, but that sector was in a bear market. So what's that sector look like? And then the technicals. But we don't weight these evenly. Right? It looks probably more like this. We want to have a understanding of the micro of the company. You have any examples?
Yeah, I thought I'd go through a quick example. I know we're not allowed to get in depth too much with it, or else we're not allowed to share proprietary stuff like that. But if we sit with the technical level, a lot of times it can be market noise.
And one thing that's happened, we talk about how unstable the oil price was, and we looked at 6 different scenarios on how we could fill that gap last week. Where could we get oil to offset some of the oil or the energy specifically lost because of the sanctions with Russia? And we went over to the U.S., the Keystone XL, and as well as shale oil, and said, well, politically probably not possible. Also, it would take quite some time to get that to market. We talked about Libya, similar thing. It would take a while to get that. The oil industry has been severely disrupted. It would take a while to get it online. Iran was probably the quickest because they have a lot of oil on tankers, but with the amount of treaties and other things that are going on right now, probably not politically viable. And that left us with Venezuela. And we had mentioned that the Biden administration was sending people down to go to Venezuela. And Chevron, March 14th, announces that they're ready to trade Venezuelan oil, and the market began to sell off. So let's just look at the overall market in oil over the last couple of years, pretty much. We could see here, and I'll get into this, it's known as a double bottom. So it's like looking at price trends to see has something changed relative to others, and just as an indicator of maybe a bottom, maybe continuing to go lower.
And you said a couple of years, but specifically you're zooming in on here just the best couple of days.
Yes, this is the bast couple of days, yes. So then we're looking at this last couple of months. And we see a double, what's already turned out to be a double sell signal. And we can see that started on March 14th. So once the market realized that there could be some available supply coming to market, it began to sell off. And we can see that big spike and the big drop down off of that. Well, if we go back a little bit in the Wayback Machine, well, I guess a few months, we can see a double bottom and how the market just shrugged it off and went and continued to make new highs. And then we had one where it had more than a couple of sell signals. And what happened is the market then, after it had more than 2 sell signals, went to the long-term support. And it tested that long-term support and began to rally. So if we start to look at this as numbers and try to understand, well, what price points are important whenever we're making decisions on oil. Remember, we had added it to the portfolio a few weeks back that helped cushion. We didn't want to add because of that spike. Well, we're looking at about $90 to $91. It would be a key point to start seeing if it recovers and then starts to ascend. If it does not, then the long-term support would actually end up somewhere in the mid-80s. Now, right now we're feeling the price at the pump. This is probably California at these prices, certainly high. But 80 to 85 is still much higher than what the economy has been dealing with for quite some time, and that we would expect a lot of inflation still needing to go in. As an example, agriculture has a lot of tractors, a lot of fertilizer, all are very energy dependent. When they're looking out and seeing the current food prices, those food prices often are not high enough to offset the additional costs. So yes, there's going to get some relief at 85, 90, and then the oil market begins to move up, but probably not enough relief. So I think there's going to be a decent amount of inflation risk still, even though we're getting a nice reprieve, and hopefully we're not seeing $7 or even $4 here in the Midwest on the price of gas. Either way, if we do continue to see inflation and we start to see some of that really get priced in the market, we can go back to the 70s and 80s, and even actually the beginning of the century, to start to see what do we do, what do we put into the portfolio to make some changes so that we could continue to move portfolios up over the long term, or at least outpace the benchmark over that time. So we'll be continuing to pay attention to that.
You may think it's a little bit of spin, but if consumers start spending too much money on gas, they have less money to spend elsewhere. So if we look, well, what's the percent of consumer spending on gas right now? We're at a historic low point, a little over 2% of their budget, but we haven't seen a gas price move up to that $7 at least nationally. If that happens, this would start to break down a little bit more, and you would have recession risk priced in even more. But if we're sitting below 3%, things are still looking okay.
Right, and this is just, like you said, it's decisions that consumers are going to have to make. I can tell you, being in 2006 or 2008, whenever gas was at $3 a gallon, it was far more painful than what it is today at $4. And a lot of it was because, well, we didn't have work remote. It was not as easy to change your lifestyle and change your use of energy as it is probably today. But if these do remain elevated, we are going to see changes in lifestyles to adjust for that. So we may still see a budget that's low, but at what expense? We want to understand that and make changes. I think that stay-at-home play will start to get a little bit more attention if people are using things that are less dependent upon them going to the gas pump to get there, but yet to be seen. So let's look at price points and what we're thinking about and talking about in the market. Now, this is a slide from yesterday. The market appreciated towards the end of the day, so it's a little bit dated here, plus it's moving throughout the morning and afternoon as we're preparing for the call. It's really good to see some support around 41.70. We had been talking about back of the napkin. We think money is going to enter this market anytime it's around 4,200 on the S&P. So far, that's held true. And to see it hit that bottom and twice people have come in on that price to actually support the market is, I would say, that's constructive.
Yeah. So support looks good, but we're getting headlines of the death cross.
Oh, the death cross. That
so the
omen.
Yeah. So everyone's talking about that. So the death cross is the 50-day average, moving average, so the average prices over the last 50 days, falling below the average prices over the last 200 days.
Right, and it's certainly a scary sounding omen. I think that's why the headlines capture it. And it's a function of math. So every time there's been a serious correction, we had a death cross at some point, right? Because then the 50-day average is below the 200-day average. Why? Because the current market is below the average price over the last year. That's a sell-off. But it's not a really good omen to decide, hey, I'm going to go ahead and exit the market. It's worked a couple of times.
Yeah, I actually looked back at the last 13 death crosses since the late 90s, and I looked at 1-month returns and 12-month returns, and it might surprise you, but the 1-month return following a death cross is actually positive. And obviously that makes the 12-month average return is also positive.
It's not surprising whenever you think about it. That's a buy the dip strategy, right? Typically the market trends up. Now, if you do act on it and it's 2008, you'll be happy that you acted upon it, but then you got to get back in, which I think is actually a better indicator is whenever you have the golden cross, which is the opposite of the death cross, when that 50-day moves back up, oftentimes coming out of a significant correction, but maybe there's some more certainty about what's going to happen going forward, and the market appreciates out of a bottom. That's probably a better indicator, but a lot of that is because markets just trend upward over time.
That's part of how I would close, is saying, while the death cross still did have positive returns. Those returns were less than average.
Right. So then the next thing that we're looking at is 4,300. Hopefully that's crossed today. That would be another indicator that maybe we're past the worst of this. Actually, I would say if we were just crunching the numbers, sharpening our pencils, looking at the data, I would say this market is a good market to buy. However, the geopolitical risks, the headline risks, if we can get and avoid them, I think the market's going to move up from here, and we can say that we've seen the bottom. The chance, though, of having a headline come out that's scary is significant. So you can't just say, oh, well, based on the data, it's a good time to buy. But hopefully we're past this, and those cooler heads begin to prevail whenever it comes to politics. We don't get a lot of headlines that are scary, and then we can get past this and start to be constructive. Because the market so far is starting to find solutions on some of the problems that we have long term. And then that gets us to the dollar.
Yeah, the safe haven status of moving towards the dollar has held still throughout this. We know that domestic stocks do well in times when the dollar is rising, and they significantly outperformed our international developed index at least. So how do you go about thinking about that and asset allocation?
Well, when the dollar is strong, you definitely want to be in dollar assets, and we think that is the right place to be right now. There is a strong reason to be investing and bias towards the U.S. Long term, though, whenever you begin to limit access to countries through their reserve currencies, they're going to start to think of solutions around, and if that detracts from the use of the dollar, long term, that could affect the hegemony of the U.S. dollar. Now, so that's making headlines. Also, what is making headlines is Saudi Arabia is considering using yuan to price oil. Whenever what is known as a petrodollar, or the U.S. denominated, get my English right, in oil, or oil is denominated in dollars. That gives a lot of support to the dollar's reserve currency, because you can always exchange your reserves for energy, and energy is such a large input to pretty much everything in the economy that stabilizes the currency. If the yuan was able to get that, then that would be beneficial for that currency as well. And historically, when the U.S. wasn't a big producer of energy, we would buy about 2 million barrels from Saudi Arabia. That's actually come down significantly to about 500,000. China, as it's developed, is now close to 1.8 million. So there may be reasons to do that. It would certainly be supportive of the yuan, but there's a lot of politics that are involved. And whenever I see that headline coming across, it's probably more to do with Saudi Arabia using some political maneuvers to try to get something out of this. And it definitely will catch the attention of the U.S. and that relationship with Saudi Arabia. So I don't think that it's going to end up being denominated in yuan, but that's certainly something that we want to pay attention to because we are so U.S. dependent, or U.S. biased at the moment.
So what's the market expecting for rate hikes? This is a week when we need to be starting to talk about this. Market's expecting about 6 rate hikes this year, and many analysts are actually calling for over 9 rate hikes. Well, why would they call for 8 or 9? Because that's what it would actually take to fight 7% inflation. You're not going to really significantly fight inflation with just a few rate hikes. Well, we don't think that 6 is going to hit. We would take the under on that, probably 4 or 5, mainly because we don't think they're going to try to fight inflation with what they really need to do, which would be significantly more than that.
Right, and my experience, at least being aware of the Federal Reserve and that there is a policy thing, has been some Greenspan, Bernanke, Yellen, and now Powell. I've always seen this is the trajectory, we're going to raise rates, and that's never achieved. So I guess I'm a cynic on that at this point, so I definitely would be under. And then if we look at just how many times has this happened, 4 or 5 rate hikes, it's really, you got to go back to the 70s to see hikes that often.
Right.
So I think it's unlikely, and I think also just with the uncertainty, the Fed is going to be more cautious and more supportive. I don't think they mean it whenever they say they want to fight inflation. I don't think they're too concerned about it so long as it is not out of control. It's just an overheated economy, I think, is what they want.
I agree. If we look at the yield curve, which we talked a lot about last week, that the yield curve spread, the 10-year yield minus the 2-year yield, and that's that blue line that we've seen coming down. Week over week, it actually looked good. So we won't be able to see that in the chart since it's a long-term chart, but we did add a couple basis points of spread, so it actually a steepening curve for a chance instead of a flattening curve. So that was good, and it supported some financials. Our financial ETF had a strong week. Looking good, at least in the short term. That's that measure that once we start seeing that 2-year yield rise, that's when inflation risks are really priced in.
Yeah, right now we're still staying invested. We're not being very defensive, or if we're being defensive with defensive equities, because we think it's too risky to be out of the market. If this was to go negative, that would probably be an indicator that things are becoming very problematic, and we would have to start thinking about raising cash at that point. So we'll be watching this closely. At the moment, money supply is high, but it's at 10% growth, where if we go back during COVID, it was at 60% growth, and there is a relative component. I think slowing out of 60 down to 10 is one of the reasons that we have so much volatility. Obviously, geopolitics is causing some of that as well. It can't just all be explained by monetary policy. Right. But we're certainly watching it. And then we talked about well, if the Fed was to begin raising rates quickly, that could cause the front end of the curve increasing faster and cause a negative yield.
And that's what LPL was showing in this slide. Maybe they didn't like us spooking people a little bit by talking about the 210 spread. They wanted to say, but wait, the 10-year minus the 3-month yield actually looks okay. There's still some spread there. And I would say, and check back in a few months as the Fed starts raising that short end, you're going to see that spread, likely a flattening curve. And that's the challenge the Fed is going to have, is if they're hiking short-term rates into a flattening yield curve, are they going to keep hiking rates?
Probably not. I think
that's probably why we're also taking the under on that.
Yeah, the economic reason of banks loaning money out, I think the LPL is correct to focus on that 3-month rate. But to your point, it's like, well, yeah, once you get a couple of rate hikes, that 3-month rate is what's going to change the most. So tell me a little bit about this slide.
I don't want to go year by year, and we've actually done a similar slide than this, but first rate hike, I just wanted to show the next 3 months historically have been choppy returns with an average of flat market. But if you look out 6 months and 12 months from that first rate hike, there are positive equity returns, at least historically.
And then that's getting us towards the end of the call. Anything else we want to cover today that we're talking about in the investment committee? All right, well, we really appreciate you tuning in. If you haven't subscribed yet, please click down and subscribe that button. If you enjoyed this conversation, hit the like button. Or if you think we need to replace this table, hit the like button. We're trying to get a new table in here, so we'd really appreciate it. Chris and I would appreciate it, and I'm sure Jess would appreciate it too if we can get the new updated table. If anyone that you know would benefit from this, hit that share button, and obviously always reach out to us if you'd like to have a discussion and talk to a lead advisor about your portfolio because you're a client, or to review your portfolio because you're a prospect listening in on the call and would like to have just a second opinion on your position. We really enjoy you tuning in and appreciate it, and we'll see you next week.